Good morning. It's Friday, the 16th of October, 2015. Today's the 28th anniversary of the Dow's biggest fall ever. That was until the Monday when the Dow dropped 500 points and we had the October 1987 crash. It doesn't look like we're in that sort of situation at the moment. And I guess markets are as fractious as they have been, but this time, instead of breaking down, they're trying to break up. For me, the key point, I guess, is that this upside volatility is still part of the same sort of pattern that we've seen with the downside volatility. But obviously, everyone's happier when volatility is on the way up. So sentiment's a volatile beast at the moment. The news in Asia yesterday that the Fed's moving further and further away from the 2015 hike was really what kicked things off. John Hilsenrath wrote an article in the Wall Street Journal, which hit about, I think it was about 9 or 10 o'clock our time in Asia. And he basically said that there's a kind of a civil war breaking out between the Fed. The Washington-based guys that are in their helicopter and trying to have a look around and see what's going on against the regional Fed presidents who are seeing some real strength in their local economies. Last night we saw some interesting data which fueled the debate in an interesting way. The CPI came in at around flat, which is with a core sense. So 0% inflation means that you don't have to worry about inflation in the US. But the CPI, while the CPI fell 0.2% in August, below expectations, it's flat year on year, according to the BLS. When you take out food and energy, which are the volatile items, it's up 0.2 and 1.9% on the year. That's right on the 2% Fed target. So which one are they managing to? Now you add to that the fact that jobless claims hit the lowest level since December 1973. That's right, December 1973, 42 years ago, last week. And you've got this real picture of an economy that is incompatible with zero interest rates. That's something I've been saying for a while now. But the Fed's still worried about conditions abroad. And I think the commentary, whether it's from the press or elsewhere, about what's going on in the manufacturing economy, and last night we saw some weakness in manufacturing indices. The problem you're getting is that the whole world, and the press do it too, is focused on what's going on in manufacturing. Just have a look at this tweet that came through from Bloomberg. You can see here, this is manufacturing PMI, and this is services PMI, right? And what you can see is manufacturing PMI, which is where all the focus is, China slowing down, emerging markets in crisis, blah, blah, blah. Now, yes, certainly, we've seen a slowdown in the services sector, a little bit. That's as true in the US as it's true in many other countries. We saw a slowdown in the Australian services sector when it was released earlier this month. But the reality is, services sector is still doing well. If you take Australia, for example, there are something like 4 million Australians employed in household services, around 2 million Australians employed in business services, and less than 1 million people in manufacturing. But it's manufacturing that gets all the headlines. So from my point of view, what's going on here is we're focusing on the wrong thing, and the Fed's been caught. Now, I was wrong in September. I thought they would raise rates. I still think, based on what I can see at the moment, that 0% interest rates are incompatible with where the US economy is right now. But it's also clear that the Fed is walking back from its move to tighten rates. Now, what did that do? Initially, you'd think it would hurt the US dollar. And initially, what we saw yesterday with the death cross that we talked about, it did. But last night, very smart move by the Austrian central banker, Nowotny. He came out and said that additional measures need to be made in the Eurozone. That means more quantitative easing. He managed to get euro down a full cent. So that's exactly what the ECB wants. The ECB does not want a lower expectation of a Fed hike leading to an increased expectation that the euro is going to rally up and through 115. So euro's back down at 113.79 today. Still relatively strong, but it's in that box of weakness rather than breaking out to a box of strength and running higher. Dollar yen's under 119. Aussie's at 73.32. We saw crude. Crude had an interesting night. Crude got down into the 45.20 region, yet it's at 46.93 today. Excuse me, there's a Aussie in here. So that's a really good performance from crude. Have to see how it goes tomorrow, but maybe it's going to rally again. I'm not sure. But more interestingly today for us here in Australia is what's going to happen with the ASX 200. So we all love a good Aussie share market. It's almost as volatile as the Aussie dollar sometimes. And what we've got here, this is our post-crash range. Now, this is a weekly chart. So, sorry, this is a daily chart. And while you can't see this little uptrend line that strongly on this version of the chart, what you can see on the 4-hour chart is that as long as this market holds above the 5217, 5225 kind of region, then it's looking like it will challenge higher. Now, the Aussie's performance is not really its own. It's dependent on what happens to the US dollar and what happens to offshore markets. And to that extent, the S&P could rally to 2050. It closed last night at 2023, and that might lift the Aussie market up to the 5,300 range. Then we'll have to see what happens. If that's in concert with a weaker US dollar, that would mean that commodity prices were rallying, and that would probably be the turbocharge that could get the Aussie market through. But for the moment, what we've got is a market that's still constrained. So we'll have to wait and see on that one. So it's another interesting day. It's also an interesting day for locals in terms of that the financial stability review from the RBA is going to be released today. I expect they'll talk about the Chinese economy. I expect they'll talk about housing debt. I expect they'll talk about investment property loans, and I expect that they will probably talk about commercial property. It may not be market moving per se, but for individual institutions, perhaps like the banks, it might be important. Of course, the discussion on what's going to happen as a result of Westpac's move to increase rates by 20 points and take that big, profit from that increase continue to reverberate through the market. Will it cause the RBA to hike to lower rates? I don't think so, but we'll have to wait and see. The other things I'm watching at the moment, Dollar Sing. I got blindsided. Thank goodness for stop loss levels. Blindsided the other day. It's come down towards the trend line we talked about yesterday. I don't have a position on, got stopped out on the last trade. It's been a good performer for me, but got stopped out on the last one for a small loss on that one. Gold, Euro's rejected the neckline from the old head and shoulders, that trend line that was there. Gold still looks good. I still think, pardon me, it's going to come back and retest its breakout level in the 200-day moving average. So 111.77, 76, 77, 78, that region. That for me is, if you're wondering why I'm wobbling around, I'm on my hover, my fluid stance board here at the moment. That for me is the key level. If it can finish the week above the 200-day moving average, it'll be the first time it's finished the week above that level for at least, what are we in October? At least 5 months, possibly more. But gold's an interesting one for me. If gold can really hold here, then it reinforces to me that dollar yen continues to have that downside bias down towards 116. Anyway, that's probably enough for me. On the day today, as I said, we've got the financial stability report in Australia. That's the main thing. We've already had Kiwi CPI. It started to hot up. We've got speeches from both the governor and deputy governor of the Bank of Japan today. I've got trade in Italy, and then EU CPI and trade. And in the US, we've got industrial production, capacity utilization, and the University of Michigan consumer confidence. I'll be interested in the tick flows. I know the tick flows. The tick flows are the investment flows in and out of the United States. I know it's kind of an arcane thing to be interested in, but I'll be interested in what foreigners are doing with their investments in the US. And then, of course, from a trader point of view, the CFTC data tonight or our morning tomorrow that will be released will tell us how much movement all these big ups and downs on currency markets and other markets have had on speculative positions. Because once we get some of those speculative excesses washed out of the market, like the Aussie market was still short, some of the other markets the same, then we can start to think about what the next leg of any rally or not might be. But for the moment, today looks to me like it's going to be a positive but fairly quiet, done it again, a positive but fairly quiet day in Asian trade. So I'll sign off. I'll be back Monday morning at the usual time. You can catch me on Twitter at Gregory McKenna. You can always catch me at Business Insider. I'm just about to write a piece now, 4 or 5 charts. I haven't decided yet on why the RBA doesn't need to cut rates, even though Westpac has raised rates. And you can also find me on my personal website, gregmckenna.com.au. Have a great day. Have a safe weekend. Hopefully the weather's nice for you and you can get in the surf. Bye for now. I'm Greg McKenna.